Welcome back, Navigators. In today's video, we will discuss how interest rates affect investment portfolios and how to make sound financial decisions from asset allocation to timing market entry and exit. So, we've all seen the headlines over the last few years. Interest rates soar, or central bank slashes rates. But what do these fluctuations really mean for your hard-earned money? In simple terms, interest rates are the price of money. When rates are high, borrowing becomes more expensive and saving can yield greater returns. Conversely, low interest rates make borrowing cheaper but can erode the value of your savings over time. Understanding this dynamic is crucial for anyone with investments. Why? Because interest rates influence everything from stock market performance to bond yields and even the housing market. Whether you're an experienced investor or just starting out, getting a grip on interest rates is essential for making smart financial decisions and protecting your investments. The relationship between interest rates and the stock market, for instance, is complex, but understanding the basics can be incredibly empowering. Generally, when interest rates rise, borrowing costs increase for companies, potentially impacting their profitability. This can lead to lower stock prices as investors anticipate reduced corporate earnings. Conversely, when interest rates fall or are expected to do that, borrowing will become cheaper, potentially boosting company profits and stock prices. However, it's not always a simple equation. Other factors like economic growth, inflation, and investor sentiment also play significant roles. Think of it like a dance. Sometimes interest rates and the stock market move in sync. Other times they go their separate ways. The key is to stay informed and adapt your investment strategy accordingly. Let's bring this to life with some real-world examples. Imagine you're an entrepreneur looking to expand your business. When interest rates are low, you might be more inclined to take out a loan to invest in new equipment or hire more staff. This can stimulate economic growth. However, if interest rates suddenly spike, that same loan becomes more expensive, potentially forcing you to reconsider your expansion plans. This can slow down economic activity. On the flip side, for savers and retirees, living on fixed incomes, rising interest rates can be a good thing, as they can earn a higher return on their savings accounts and bonds. But when rates fall, their income from these sources can decrease, making it harder to maintain their living standards. The relationship between interest rates and the stock market is, as is evident, complex and multifaceted. Higher interest rates generally lead to lower stock prices due to increased borrowing costs, reduced consumer spending, and more attractive alternative investments. Conversely, lower interest rates can boost stock prices by making borrowing cheaper, encouraging investment and spending, and reducing the appeal of bonds and savings accounts. So, how can you protect your investments in a world of fluctuating interest rates? Diversification is key. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes such as stocks and ETFs, bonds, property, and even alternative investments like gold. When interest rates rise, bonds tend to perform better, providing a cushion against potential stock market declines. Conversely, when rates fall, stocks often outperform, while bonds lag behind, and not to mention bank savings accounts. Another crucial strategy is to invest for the long term. While it's tempting to try and time the market, jumping in and out based on short-term interest rate movements is rarely a recipe for success. Remember, investing is a marathon, not a sprint. Stay focused on your long-term goals and ride out the inevitable market ups and downs. Trying to perfectly time the market, buying low and selling high, is incredibly difficult, even for seasoned professionals. It's like trying to catch a falling knife. You might get lucky once or twice, but eventually you're bound to get burned. Instead of obsessing over short-term market fluctuations, focus on what you can control: your investment strategy, your risk tolerance, and your long-term financial goals. Remember, time in the market is often more important than timing the market. By staying invested and riding out the ups and downs, you give your investments the opportunity to grow over the long term. Therefore, even with the best intentions, it's easy to make investment mistakes. Here are a few common pitfalls to avoid. When markets tumble, it's natural to feel anxious, but panic selling often leads to locking in losses. Instead, take a deep breath. Remember your long-term plan and stick to it. Oftentimes, after a decline, markets get higher again as they move in cycles. Don't be lured into chasing the latest hot stock or investment fad. Often, these are driven by hype and speculation, not sound fundamentals. Fees can eat into your returns over time. Be sure to understand the fees associated with your investments and choose low-cost options whenever possible. Investing without a plan is like sailing without a compass. Take the time to define your financial goals, risk tolerance, and investment timeline. The financial world can feel like a roller coaster at times, with interest rates and market conditions constantly in flux. But by understanding the fundamentals, developing a sound investment strategy, and avoiding common pitfalls, you can weather the storms and build a more secure financial future. Remember, knowledge is power. The more you understand about interest rates, the stock market, and the forces that drive them, the better equipped you'll be to make informed financial decisions. Stay informed, read books and blogs, search for podcasts, and build your knowledge. Also, don't be afraid to seek professional advice from a qualified financial advisor. They can help you create a personalized plan tailored to your specific circumstances and goals. And most importantly, stay calm, stay focused, and stay invested for the long haul. The power of compounding, combined with a disciplined approach, can help you achieve your financial aspirations over time. That's all for today. Until next time, take good care of your finances, navigators, and don't forget to subscribe and share if you found any value.